Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilburn. I'm joined today by Bob Iacchino. Welcome, Bob.
Thanks for having me, Jeff.
Well, earnings season is here. We saw JP Morgan kind of miss a little bit, ticked under $100, but I know markets have recovered a little bit from December, but what do you focus on this week? Is it earnings season?
It's definitely earnings season, given all the other headwinds that the equity markets have. It'd be nice to see some revenue and EPS beats. We've seen a mix of the two, probably not enough to get us going just yet.
And quickly, what are your thoughts on forward guidance? Seems so critical right now.
Well, last earnings season, we had about 70% lower their guidance. So I think they're lowering the bar and they want to jump over that bar. So going forward, I'd like to see it steady to higher. I don't know if we'll get it.
Oh, great point, Bob. Let's get into this first lightning round. You ready?
I am ready.
Is China slowing? Well, this has been the question. We talk about the data coming out of China for the last couple of months. Maybe that kind of translates into the price of crude oil going lower, which in turn turns into a proxy for the stock market. But how are you viewing this China slowdown, and is it real?
Well, there was talk overnight of China adding even more stimulus in the form of giant tax cuts on all levels of the tax payment cycle that they have. So I think you're right about that proxy with crude oil. China's got huge demand in crude oil, so does India. So I'm actually looking for a little bit of a pop in crude oil coming forward.
Oh, that makes a lot of sense. So what type of trade example would you approach as you see the momentum continue to come into crude oil now it's above $50?
Well, normally we like to sell the higher volatility here, but volatility on crude oil has actually been dropping for the last 10 days or so. So I'm going to go ahead and buy a Jan week 4 call spread. It's the 52.55 call spread for $980. It's a little pricey, but it's close to at the money. That's a $3 call spread that expires Friday, the 25th of January. February is the underlying futures contract trading at 51.90 when we price this, and at the money vol was trading at 38.6, and that is lower than it was 2 weeks ago.
Significantly lower. It was above 50 just 2 weeks ago, so it's great to bring up that point as you've seen a little bit of the volatility settle down, and maybe that means a little bit better things for the stock market as well, correct?
Yeah, it should, and as we get these production cuts that come through, if crude oil rallies, energy sector rallies, and if it's a proxy for demand out of China, you're right, stocks should rally as well.
All right, please remember these are trade examples, not trade recommendations. Let's move into the second lightning round, pal.
Ready for it?
Trade tariffs. Wow, we can't get out of Asia right now, but that's fantastic because these trade tariff conversations, the United States with China, seem to have produced a little more optimism. Is that true?
Yeah, they've advanced, definitely, because you're getting positive rhetoric out of both sides, not just out of the U.S. You're getting it out of China as well. Vice Premier coming in at the end of the month, so it looks like we're moving forward in a positive way.
Well, that's awesome. And the trade example I want to utilize today, Bob, is look at the price action, the E-mini S&P 500. It's consolidated. Ever since we've come off of Christmas Eve's near test of 2,300, we've been probing this 2,600 level. So what I envision, if we do have any optimism come out of these trade talks or any advancement to your point, we see the markets move higher. So I want to define what I want to pay for this upside participation by buying an E-mini 2650 Jan week 4 call for about $350, and I'm selling that 2700 Jan week 4 call for about $60. So net, the cost of this call spread I'm purchasing is about $290. This will allow me to participate in the event we see this market, which has been coiled for the last couple trading sessions, move higher.
Yeah, I really like this because I agree with you. If we get a China deal, the dominoes start to fall with positive view of maybe a Europe deal and possibly helping Europe out of the potential recession. U.S. stock markets will lead if that's the case.
Yes, and this trade expires on 1/25, January 25th, and the underlying E-mini S&P 500 was trading right around 2601 when this was priced out.
Yeah, again, I like this a lot. I like the upside more than the downside, at least given the lows we put in at the end of last year.
And last thing, whenever we're approaching and buying a spread, it's always important to understand the volatility. We've seen the volatility in the E-mini S&P 500 significantly come down as well. Right now, the at-the-money volatility is around 15.
Yeah, it's down again today by another percentage point, by the way.
Fantastic. All right, Bob, I want to thank you, as always, for coming on Striking Options. And please tune in every week as we will continue to strike options.